Hi, I'm Brian Dodson, and I'm one of the tax attorneys at Steidl and Steinberg Tax Services, and I'm here to talk to you today about your tax deficiencies. And one of the best ways to handle your tax deficiencies, and probably the only way the Internal Revenue Service offers you to reduce your liability, is the Offer and Compromise program. Offer and Compromise sounds like a wonderful program. The general thought being, of course, that you make an offer and they reduce your taxes concomitant to your offer. The system doesn't work that way. Like the IRS in virtually all situations, offers and compromise are determined, and your ability to get an offer and compromise is determined based on your financial status and not the amount you offer them. So the typical idea of a negotiation does not apply to an offer and compromise situation. What you must do when you file an offer is to send to them a form, a 433A form, with financial information. Two types of financial information are required. First, you need to list all of your assets and liabilities. Second, you need to list your monthly income and your monthly expenses. The IRS performs a two-step operation on your financial situation. First, they basically add up your assets. They take 80% of your net equity in your home, 80% of the net equity in your cars. They take 70% of any equity that you may have in retirement plans. Other than that, they add up the totals of everything else and get them to a number. They then look at your monthly income and expenses. Monthly income simple, they add up your total gross revenue for each month. Your expenses, however, are subject to limitations. First series of basic living expenses, such as food, clothing, and miscellaneous expenses, housing, utilities, vehicle ownership, and operating costs, are all limited to national standard numbers, which are averages the government keeps for people in your area of the country for these numbers. If your expenses exceed the national standards, then you're only allowed to deduct the national standards from your monthly income. Other expenses are ignored completely. Unsecured debts, college tuition, etc., etc. Taxes are allowed 100%, health insurance is allowed 100%, court-ordered payments allowed 100%. After all these adjustments are made to your expenses, expenses are totaled and subtracted from your monthly income. At that point in the offer and compromise scenario, that number is factored by a number. That is, it's multiplied. If you offer a lump sum payment, they multiply it times 48. If you offer them a 24-month payment, they multiply your net monthly income by 60. And if you want to pay it out over the 10-year collection statute, they multiply it times the number of months left in the collection statute, which can be as much as 120. They take that total, they add it then to the asset number they previously calculated, and the total of those two numbers works out to be your reasonable collection potential. At that point, if your reasonable collection potential is less than the amount of tax due, then you qualify for an offer and compromise. However, the interesting part of it is the government wants you to pay your reasonable collection potential and not the amount that you offer. If you can pay the reasonable collection potential, the good news is once you've paid that number, your tax liabilities are gone. You don't have to pay interest, you don't have to pay penalty. That number is amortized with each payment that you make. If you're lucky enough to qualify for an offer and compromise, it's an absolutely excellent way to reduce your tax liabilities. If you have any questions or you need to contact us about this program, give us a call and we'll help you all we can.